Hello, everyone, and welcome to the Unfair Edge podcast. Today, I'm joined by Peter Walker, head of insights at Carta. He really needs no introduction because you've probably seen his data on X or LinkedIn. But Peter, in my opinion, is the best data storyteller on the internet, specifically when it comes to private markets and with a strong focus on venture capital. So, Peter, super excited to have you on the podcast today. Thank you for joining us.
Jace, thank you for having me. That is altogether too kind, but I'll try to live up to that introduction.
Well, people like you who post really, really insightful, thoughtful, data-driven content are much needed. So me and the rest of the Twitter universe, thank you. Well, Peter, I think everybody obviously knows you very well because of the data that you post and the insights that you provide to the industry. What I want to do is first sort of peel back the curtain on your career journey. So
Yeah.
how did you get to become the head of insights at Carta? What was your path to get there?
So it's been sort of a circuitous route, but kind of the through line has always been startups. So I started a company in college with a couple friends. Didn't really go anywhere, but it was where we all three of us got the bug for, hey, I'd worked like a summer at a hedge fund. I'd been like, what am I going to do? And that sucked. I was like, never again. And then we did this company together, and it was amazing. And so then right after school, I joined a startup out east called Public Relay that did media intelligence, effectively like early natural language processing for media content. Joined as an analyst, but quickly started like running data teams, and then kind of burned out of that and ran marketing for a while there and took on a bunch of different hats. And that early startup journey is really the place that I love and am connected to very deeply. 10 people in a room trying to figure out a company. That's amazing stuff. And then during the pandemic, I was still working at Public Relay, but I had moved to San Francisco because my then girlfriend, about to be wife, had gotten a job out here. And COVID hits. We're all, it's March 2020. Nothing is open. Everything is shut down. Everyone's pretty scared. I get on Twitter for the first time. I don't know why I wasn't on it before, but whatever reason, I start doing this thing that I usually do when something happens, which is I think in terms of charts. So I go out and find data sources and I build charts about them. And I'm like, here's what's going on. And that started getting some pickup. And then the Atlantic magazine reached out and they were like, we're setting up this little sort of side project within the magazine to study COVID data. So we already have this thing sort of off the ground and spinning called the COVID tracking project. Do you want to come? And at first it was a volunteer thing of like, just spend some time working with our charts and figure out what's useful. And then that kind of rapidly spun into leading a viz team there through the heart of the pandemic for about a year and a half. So that was a wild experience.
Sure.
None of these people had ever met each other. We were all just on a Slack working together all the time, trying to figure out why the CDC sucked so badly at putting out data, trying to figure out what like actually was going on in state and municipal websites. We're like doing all this aggregations and data stuff. And then my role is to build the story out of that. And so that was an MBA in, data storytelling at scale. But that definitely was the sort of kernel of this idea that was, if you have a data set, you can build brand through data content in a way that I think more companies should be doing. And so I made a list of the 5 or 6 companies that I thought had data assets that are worth doing this with. And Carta was number one with a bullet. So that was, I kind of, found my way into the CMO there and pitched my job and said, hey, I think that this would be an amazing motion for Carta. It doesn't really exist exactly like this right now, but I think we could build something together. That was the pitch.
Yeah. Speaking of Carta content, specifically as far as like types of data that gets the most run on a platform like X or even LinkedIn, which charts, when you put them out, do you know are going to cause the most amount of conversation?
Well, here's the, peek behind the curtain on some of the content strategy. You can build data stuff. There's basically 3 ways to build, I would say, data content that's really useful. The first is ongoing reporting that just is state of the market. So, which is always very useful, especially if you're, speaking like I am to venture founders and venture investors primarily, just telling them, hey, in Q1, here's what a seed round looked like, here's what Series A looked like, et cetera. Really valuable. Just give them a grounding in the market. And because Carta has so much data, it just naturally has that air of authority. So that matters. That's content one. Content two is the one that everyone wants to do more of, which is you think X is true, but actually it's Y.
Right.
The disproving, the controversial take, the whatever. Can data do that? It can. When I've had those pieces, they do tend to do well, so I don't think it's wrong. But it also, you see a lot of people searching for that. You see like the headlines are written in such a way that makes it seem very controversial, and then you dig down into the study or whatever, and it's like, this is very mild. Like, this wasn't what you were saying.
Right.
And then the third kind of content, which I think more people should do, which again, data is uniquely suited to do, is to actually say, everyone thinks X and it's true. And that doesn't seem like it would be a very useful piece, but it's actually really great to be the source of evidence for something people already believe. So and a great example is dilution for startup founders being 20% at seed and 20% at A. Most VCs are going to say the exact same thing. But if they point back to our graphic, which shows the market, great. That's win for us, right? We become the trusted source, the authority in startups, which is what my job is about.
Yeah, that's super interesting. I can't tell you how many times I've seen something on X. I've literally gone to your account and been like, all right, does Peter have something on this that would validate what I just saw or what I heard on a podcast? Let me see if that's true. Yep. And oftentimes, your data validates it, and then sometimes it doesn't. So yeah, you're absolutely right. And then also
when
as well,
GM that person, you're like, you're wrong. Yeah.
Right, exactly. And then even as as well, on your ongoing stuff too. I love how you're like constantly tracking how was median, and we'll talk about it in a little bit, like how has median ARR changed over, quarter over quarter, year over year, time period over time period, I guess you could say, when it comes to like ZERP, non-ZERP. So yeah, I've certainly referenced that as well. So what you talked about the 3 buckets. I'm curious, what percentage of your time is spent as, head of insights? What percent of your time is spent on providing insights to customers of Carta or clients of Carta / then providing the data that you see that the general public sees? Like, how do you spend your time?
Yeah, my time is probably split. You can think of my time in sort of 3 ways. So I run the insights team at Carta, and we are a team of 3 people, myself and 2 others now. Mm-hmm. For the first couple of years that I came into Carta, it was a solo practice. And then, a lot of my time is spent actually querying the database, building all this data, finding the interesting stuff, writing the stories, putting it out, doing the big reports, the content, whatever. Mm-hmm. Now it's probably half of my job. And within that is a big part that has become, again, not necessarily expected on my end, but the speaking aspect is so much more of my time now, which is great, but takes you away from building. 30% is then internal work with other teams about how do we use this data internally at Carta better for their decks, for their conversations with sales, for their conversation with customer success, whatever it is. And then the last remaining part is spent with our product teams, like really deeply thinking through how do we build data products at Carta that take advantage of our market leadership in this way and like supercharge it, as you mentioned, for clients. Like, clients get amazing data from us that we don't put out into public. Mm-hmm. So but we have so much that we can still use this for brand in interesting ways. I think a lot of companies with data treat that phrase, data is the new oil. I've never liked that phrase, because oil, once you burn it, is done, and data is replenished. Like, you can use data in many different ways. So it isn't a one shot, like, make somebody pay us for a PDF or else we've wasted the numbers. Like, that's not the point,
Right.
My work is not in any way in conflict with us building data products.
Mm-hmm. Yeah, absolutely. I mean, if anything, it probably amplifies it, because it shows what funnel, it gives. Right? Exactly, right? It's the tip of the iceberg. Shows what you can do, and then what you have underneath the iceberg is just so much bigger.
It's a perfect example, like Carta Total Comp, our product that helps you pay correctly for private tech. So we have 1 million startup employees on the platform. We can tell you better than anyone in the world how much you should pay that engineer in San Francisco in salary and equity. That product is available to all founders. I talk about comp a lot, but it does in no way replicates what you would get from a full-fledged product where you can actually see comp bands and plan it out and hook it into your HR system. Like, all of that is such amazing benefit. My work and the comp team's work are very symbiotic, where there's no like competition there.
Sure, absolutely. I want to talk quickly about LinkedIn, and then we can shift to sort of state of venture capital. So we were talking before this about the LinkedIn channel, and I would just love to get your thoughts on LinkedIn as a marketing engine. And I say this because, this podcast is very much focused on founders. And so founders, every time they listen to this podcast, they should come away with something that gives them an unfair edge in building their own company. And so a lot of them are looking to build their go-to-market motion. And I think a lot of times on X, not all the time on X, LinkedIn is looked down upon. So I'd love to get your perspective. Someone's grown a massive brand, over 150,000 followers on that channel, your perspective on it and how it's been accretive to what you're doing.
I think it's way better than X if what you're doing is trying to reach people in business. So the very basic is I know who reads my stuff on LinkedIn and I know they're real people. Great. So you can blow up on X, although virality is much harder there. People like Cluely and others like trying to hack it now. I get that. Sure. But in general, if you put out content on LinkedIn and build a brand and a following there, the people that interact with your content you have their job titles. You know where they work. You know if they're great prospects. I just think it's a much better way to build an audience where I feel confident that audience is the right people. Those are the right people to... my audience is full of startup founders, startup investors, and startup employees. That's who listens to me on LinkedIn. And every single person who is on X is also on LinkedIn. I promise you. They just don't talk about it as much. Which means they're probably not creating content there, which means they're much more lurkers and just scrolling the feed a little bit, which is great because then you get to create content. So, and not to say you have to choose one or the other, but in general, if you build an audience on X by shit posting, and then you build an audience on LinkedIn by founder-led brand, my guess is that founder-led brand on LinkedIn is going to be more lucrative to your business than the shit posting on X. It won't feel as good. You won't get like all the kudos, whatever, but you'll make more money.
Right. There you go. And that's what matters. That's a non-consensus and right take, I think. So then pivoting to one of the things I was telling you is I saw recently Bill Gurley did a state of venture capital overview on a recent podcast with Patrick O'Shaughnessy. My goal for sort of this section of the conversation is to really have a similar conversation with the data that you've produced to the forefront. So not necessarily what someone may have observed, but particularly with data. So I've got a handful of data points, so we'll talk about that as we go through. I would love to get your perspective on each one of those because at the end of the day, you're the one that pulled them together. So first one is I want to talk about raising a seed round right now, and particularly looking at valuations today versus last year. So I think it was in the Q1 2025 private markets report. It stated that the median pre-money seed valuations rose 18% year over year to 16 million. So median pre-money seed valuations rose 18%, but the count of seed deals is actually down by 28%. So can you talk about this paradox and what it means for founders that you have median pre-money seed valuations rising, but then the count of those deals decreasing?
Yeah, so I think it's like it well encapsulates what's actually going on in venture here, which is if you just look at venture by total dollars raised by startups, 2024 and 2025, are going to look pretty good. That is not what's happening. The reason those years look pretty good is because a tiny number of AI companies have raised literally massive amounts of capital, way beyond capital raises that we have ever seen by that young of a cohort of companies. I mean, Thinking Machines, Mira Murati's new startup just raised a $2 billion seed round. That is not a seed round in any way, shape, or form, right? It just is called that. So that is, I think founders should ignore the total cash raised and they should focus on the deal counts. When you do that, fewer companies are raising venture. Why? Because the bar has gotten higher. So in 2021, it was truly a bubble because we were applying these valuations to companies that had no right to this level of valuation. There were companies in 2021 that were raising $100 million and they had $1 million in ARR. It doesn't make any sense. Those were frothy, those were hype, those were bubble times. Now, yes, there are big rounds being raised, but oftentimes the actual underlying traction and metrics are way better. than they were, like 2 to 3 times better than they were in 2021. So it's a little less hypey, more actual revenue. And that gets us to the valuation part. There are a lot of investors in the market, but they have very high expectations. So individually, they invest into less deals, but collectively, the ones that are the most consensus, their valuations are going to get pushed up because they have multiple term sheets competing for the same company. So in that case, I think it's pretty obvious that in a world where there's a ton of money, quote unquote, available, but fewer deals happening, the deals that do happen are more expensive than the ones that they used to be.
Right. Interesting. Yeah. And you see that, I mean, that's the conversation that you hear on platforms like X. That's what you hear people saying. Oh, I saw X amount of deals and they were so expensive. So, I only committed X, X percent or X
Correct.
point.
And they're still talking their own book there. Like,
sure.
I'm sure that they saw a lot of deals and they could have done. I mean, to me, what it suggests is that, and this is maybe a slightly controversial opinion, but like VC should probably do more deals. Like, there should be more deals for the people that are not as good looking, quote unquote, in terms of their traction, their metrics, whatever. Do more weird deals where you're like, this is a cool founder, but I don't understand their business at all, and they're not making, like, yeah, if it blows up, it could be amazing, but I don't really get what they're doing right now. Maybe take a chance on that deal because it's going to be less consensus than the ones that are not. Like, there's so much focus on consensus people at the moment. Did you work at the right research lab? Did you come from the right graduation background? Are you a repeat founder with an exit? If you are those 3 kinds of people, you just get funded way more easily than you used to. And if you're not, it's harder than it's ever been. And that, to me, like, venture should be about taking the weird bets, not just the most consensus ones.
Yeah, absolutely. I'm going to put a pin there because I have one question specifically about that. Before we go to that question, I noticed that this specific data point around seed valuations, you put that out as pre-money. Are you doing that because of the amount that investors are committing so that you want to basically give a more true view of the number outside of the investment itself? Or why are you doing pre-money versus post in this case?
I think that, yeah, so I think that pre-money, which is just the value of the company absent any of the round that's actually coming in.
Right.
I think it is a little bit of a more equitable tell on like what the actual market looks like, because as you mentioned, if you include the money, then it depends a little bit on the round size, what the post money val is. Both are fine, and both paint a pretty similar picture, which is higher valuations, pretty big rounds or growing rounds, and fewer of them happening. I think that's true basically across many stages in venture.
Yeah, and I like the pre-money approach to that because I think, if investors feel like they need to commit more capital because of, let's say, resources that maybe founders didn't need before, like, more compute resources or something like that, then it might skew the round value relative to historical periods when maybe you didn't need that so much.
Yep.
So super interesting. Going back to the expectation of those founders who investors may pass on when they should be taking bets on those people. We can't say this for certain, but to me, like, I sort of most liken that to some of the quartile work that you've done. And so I had some numbers here. I'll pull it up in the video. Whoever's watching this on video, I'll put it up in video. But for those who are listening on audio, I'll sort of explain what that chart said. So Peter had shared some data on X, and I'm sure LinkedIn as well, that showed the change in ARR from 2021 to 2024 by quartile. So it was a lower quartile, a median quartile, and an upper quartile. So the ARR change from 2021 to 2024 for companies who had raised a Series A was 160%, going from $500K in 2021 to $1.3 million in 2024.
Yep.
That was the ARR. The median quartile was up 115% from 1.4 million to 2.9. And then the upper quartile had an 89% change from 3.6 million to 6.8 million. So I just wanted to get your take on this phenomenon that you're seeing in the market as well. And then also, like, in that case, that was seed to Series A. So before we were talking about seed, now we're talking seed to Series A. In your mind, I guess, what can founders take away from this analysis of the Series A market?
this was like a combination analysis that we did with Silicon Valley Bank. So Silicon Valley Bank provided the revenue data, and then we provided the valuations data. So shout out to them. I think the takeaway is really pretty clear, which is one, investors have much higher expectations for what your revenue should be at Series A. You cannot raise a Series A with $1 million in ARR anymore. Or excuse me, you can if you're growing incredibly fast, but probably you cannot. And the point about the quartiles that I think you made well is that actually the place that has seen the most change is the lowest quartile, so the bottom 25% of deals. And that makes sense in a market in which investors are doing much more due diligence, they're being more careful about their investments. Their expectations for what even gets close to the bar probably move most at the lower end. And then like at the higher end, yeah, if you have $4 million at 2021, you were amazing. If you have $4 million at 2025, you're also pretty good. Maybe not as good, but you're like well within the range. Whereas it used to be like, we're just seeing that lower quartile, basically deals that used to be on the margin are just no longer getting done. You have to show up. And founders look at this and look, this is part of the culture of startups. You are not just competing against deals that investor has seen that week. You are also competing against the general, quote unquote, amorphous expectation of what good is. And if Cursor and all of these AI companies are growing faster than we've ever seen before, then good is higher. So you can't, like, this is what it being a VC is about, is trying to bet on the generational companies. I think it makes sense that if the cultural air around what good looks like has gotten 3 times higher, VCs are going to demand 3 times more traction, revenue, momentum, whatever it is, before they invest in your company. So the bar is up and up and up.
That's super interesting, because what I hear from that is, if I'm a founder looking to raise, which of course you don't have to raise, we'll talk about that in a moment, but if I'm a founder looking to raise, there's almost like unique opportunity with potentially emerging managers who may not be able to get into the same deals that some of these other let's say, household name venture capital firms can get into. These emerging managers might be willing to take a bet on a company that may not be ready to meet that bar that you're talking about. But you might have a great founder, they're just not there yet. Do you agree with that?
I would hope so. I mean, we haven't spoken much about the way that on the VC side of the business things have changed, but if you're an emerging manager, you cannot compete with a mega fund strategy. Like if you're playing as a mega fund strategy, meaning you're just looking for the most consensus founders, you're trying to get into the hottest deals, you're just going to get wiped if you're an emerging manager. So hopefully many of them have a different set of strategies. I don't know if that necessarily means they have lower expectations.
Sure.
Which is weird. Like it's just everyone's trying to answer the same questions. How fast is it fast enough? And how much capital do you need? And everyone kind of has a different idea of what that is, but all of it is higher and higher. So I don't think that, I'm sure startup founders have pitched a bunch of emerging managers and still gotten a lot of no's. Sure. And it's not necessarily the case that they're going to find like a much more fertile ground there. I hope they do.
Right. Interesting. Yeah, and I know there was another statistic that you had provided previously, and it was maybe earlier this year. It said the median age of a company that raised a Series A was 2.8 years.
There's this mix, right? There's this mix of expectations, which is how much money do I need to make it to the next round?
Right.
And within that question, there are 2 things, which is how fast am I growing and how long do I have to make this money last? And like founders should expect to need to make that money last much longer than they used to. Much longer. If you cannot survive on the money you have in the bank right now for 1,000 days, think about raising immediately, right? And because one, raising is going to take longer than you think in this market, unless you are one of the AI chosen few, for sure. 2, you are going to need to make decisions way in advance about your burn rate, how much you're spending on growth, your team. If you show up at a VC's door and you go, we have 6 months of revenue or 6 months of cash left and we're growing not that great, good luck. No chance these days. No chance. So It's just like as the time between rounds lengthens, some of that is because companies are trying to fundraise and have failed. Some of that is because companies raised a seed round, say, and they're looking around going, we don't really need a Series A right now. We're growing pretty well. Our burn is very low. It can be good or bad, but what it can't be is a surprise. You cannot be surprised by your burn and how much cash you have left. That is the number one thing VCs cannot stand, is when you are not on top of that.
Right. What's the best way? Like if you're a founder, and of course VCs are going to give their founders their tools to do this, but like, if you're a founder that's gearing up for this, what's the best way for them to start to think about and even potentially manage? Like which software do you recommend for people to manage these things, these burn rates,
etc. There's so many interesting and cool softwares to help you do FP&A as an early stage founder. I wouldn't say you need to spend, a ton of money on it, but like Puzzle is one that Sasha Orloff's company, Puzzle, does a fantastic job for early stage founders. I think there's a couple other ones that are growing that are cool. But I mean, that's like core to your job. How much money do you have in the bank? How fast are you spending it? What are your metrics? How are they changing? You as the founder should sleep, eat, and breathe those metrics. You should know them. So like, not only do you know them off the back of your hand, you know the ones that layer down of like why it's changing, et cetera. Like that is a core job for you, especially when you go and pitch. And even then, you may get the thing, and this is happening a lot, where, okay, VCs raised all this money, but they're not investing into new deals right now. So like, what the heck are they doing all day? A lot of them, and this is a credit to many VCs, they're spending time and attention and capital on the stuff they've already invested into. There's a lot of companies that were born before ChatGPT that raised a good amount of money that are having to completely transform their businesses. And VCs are trying to bridge those companies, extend them, get them to a place where they can make it to the next round or figure out what an exit looks like or something. That takes a lot of time and attention. It's more bridge rounds that have been happening lately than we've basically ever seen. And that probably isn't great financial decisions for the investors, but I think it speaks well of them that they're willing to do that for the companies that they do invest into.
Yeah, absolutely. That's great advice. And then I want to talk a little bit about, so this is the data that I've got here is seed and Series A data. So I want to talk a little bit about the current fundraising expectations for founders today. So particularly round size and amount raised. So you provided some great data that showed a snapshot of startup valuations, round sizes, and dilution in Q1 2025.
Yep.
In this data, the post-money valuation for a seed stage company had a range of 12 million to about 27 million. I think it's worth saying right now as well, these are rounded numbers, but it had a range of 12 million to 27 million. That was the 25th percent quartile to the 75th percent quartile. So 25th had 12 million and 75th had 27 million.
Yep.
That same data for Series A was 39 million at the 25th percent quartile, and then 100 million at the 75th percent quartile. So the cash raised, and then the cash raised for a seed stage company was 1.7 million to 5.5 million, and for Series A company was 5.6 million to 19 million. In your mind, there's a lot there, but in your mind, what are the big takeaways for founders from that data?
The point there is that the post-money valuations have gone up a lot. I mean, we talked a little bit about the pre-money, the post-money when you just add in the cash. Same thing, right? Hey, let's take the medians for a second. A $20 million seed stage company is expensive as hell. That is literally never happened before. Like, this is a new phenomenon. I know founders get annoyed at like VCs are not giving us deals, et cetera. By our data, VCs are being real generous with their post-money valuations. That's probably too high, candidly, for a lot of those businesses. But what's happening is that a lot of them have raised pre-seed before. They're probably much further along than they were for the seed stage companies in, say, 2018 or 2019. So the valuations just keep going up. And there's a lot of people who want to get in at the early stage. There's a lot of different investors around. Some VCs, some angels, some family offices, some mega funds. They're all competing for seed stage rounds. So those valuations are high. The real sort of drop-off point in our data set is Series A. A lot of pre-seeds get raised. A decent number of seed rounds get raised. And then there's a bit of a cliff. And like making it to Series A is a really hard thing to do these days, especially if you are, well, maybe we'll talk about this as a separate topic, but the gap between AI and not AI is just it's a chasm right now. It is really, really big. And there's no way to, how do I put this? It is becoming increasingly difficult for companies that are building software that are not AI native to be attractive to VCs at the early stage. So I'm not saying it's no companies. What I am saying is if you don't have an AI story for your business and you're a seed stage startup, you need to build one now.
Right.
If you're writing software. If you're building physical products, maybe it's a different thing. But if you're writing software, you better be AI native if you want to play in venture capital. It's just basically a prerequisite.
Yeah, absolutely. That's great. That's great advice. Yeah, and that's an interesting point as well that you touch on, which is more and more companies are raising that pre-seed capital. And so because they're raising that pre-seed capital, they are farther along, which pushes the valuations up at every single stage. Super interesting phenomenon. Obviously, the competition that happens at seed now, everybody's got their different reasons that they play in seed, but the competition at seed now absolutely pushing those valuations up. And the AI story, I mean, I know it's a bit of a joke that everything's an AI product now, but at the end of the day, what you just laid out is exactly why everything is an AI product, even if it's just sort of an ancillary AI product.
Both things are true, where everyone's kind of making fun of some people in startups because it's like, AI for dog walking and AI for lawn mowing and AI for whatever.
Right.
So are we in a bubble? Yes, totally. But does that mean that it's going to be all wasted? No. There's going to be there are already generational AI companies being built, and it's just the kind of foundational thing you should be taking advantage of. I am looking forward to the day, I think it's going to be in about a year, maybe 2 years at the very most, where we don't talk about AI valuations and non-AI valuations. We just talk about software, hardware, biotech, et cetera, because it's just assumed. We don't talk about JavaScript valuations, right? If you're not using AI in another year, you're just not building your company with the latest tech. That's all. That's just how it goes.
Yep, absolutely. So if we're thinking about sort of the state of venture capital, is there anything that you would say like, here's the state of venture capital that's relevant for founders?
I think the one part of VC fundraising that we haven't really touched on is, or maybe we touched on it, but not in this specific a way, which is dilution. So how much of your company are you selling at these stages? I think one thing that many founders think they know about VC, but then they get into fundraising rounds and it turns out they really didn't know, is just how dilutive venture capital actually is. So as an example, you're probably going to sell 20% of your company in your seed round and 20% of your company in your Series A round and 10 to 12% of your company in pre-seed. Add that up. By the time that you exit your Series A round, you as the founding team will almost certainly own less than half of your company. It's pretty rare to own more than half of your company after Series A. There's Series B coming up, Series C, Series D. There's a lot of series left. Venture capital, and this is an illustration of venture capital thinking for founders who are just at the beginning stages, which is you need to think very clearly about whether or not you need to take VC. Because the moment that you take VC, you are committing to their growth paths and their expectations. And if you don't take VC, you can grow in totally different ways and have wonderful outcomes. Maybe you won't IPO as often, but you still can have an amazing outcome. And so you just need to be honest with yourself about what kind of business you want to build.
So, okay, that's an interesting topic. If you're a founder and you raise, let's say, a seed round, a few $1 million at seed, and you have good growth, not massive growth, but you have good growth, then how should a founder manage their investors' expectations for raising the next round if they don't actually need to raise another round? So if you raise your seed and you're like, we have the ARR numbers here, 1.3 million. That's the ARR expectation at Series A.
Yep.
So let's say you're there, but you're managing your burn well enough. and you think you keep going, how do you manage your investors' expectations who want you to raise a Series A because they want the valuation to go up?
They definitely want you to raise a Series A, right? So like the real question is, why did you raise a seed in the first place?
Mm-hmm.
That would be a mistake on my part if I messed that up. If I'm the founder here.
Right.
And the growth rates are pretty standardized, but excessive. So, oftentimes what was stated in the old world, pre-AI world, was triple, triple, double, double, double. Meaning you need to triple your revenue in the first year, triple it again in the second, and then double it years 3, 4, and 5 in order to go from $1 million in ARR to $100 million in ARR in like 6 years. That was the standard for a VC SaaS business. That is very fast. So if I'm this founder, I raised a seed round, I am somehow either break even or even slightly profitable, but I'm growing 20% a year, 30% a year, heck, even 40% a year. I'm not growing nearly fast enough to be attractive to more VCs. I'm not even close, right? If you're growing 50% a year at seed stage, you are not even close to growing fast enough. So what does that mean? Does that mean I need to shut down my business? No, it doesn't. You just need to make sure that you don't take any more venture capital. And so that's going to be a not fun discussion with your current VC. And you're going to go, look, y'all, I appreciate it. The money was great. We're in a break-even state now. I'm going to try to build this business in a capital efficient way. Hopefully we can get to an exit where everybody makes a little money. But until then, probably not going to take much more venture capital because our unit economics make sense where we are right now. Most of the time, I know it feels like everyone's talking about this on Twitter all the time now, but I don't agree with it. You're still not profitable as a seed stage company. Almost all of them are unprofitable. So you need to make the trade-off between, do I use capital to fuel growth or do I cut burn and don't expend capital and improve my profitability? Usually margin and growth are on a seesaw. It's very difficult to improve both at the same time. If you can, amazing, you're an awesome founder. If you can't, which is more natural, you need to pick. And it's better to pick. It's way better to pick before you take VC than after you take VC. Because those, as you mentioned, those seed stage investors are not interested in your company just kind of stopping after a seed round and like becoming a lifestyle business. That's not why they invested in you at all.
Right. Yeah, that's the untold story. That's the piece that I don't think founders who haven't waded into that world before, who may be listening to this podcast and have been like, oh, that would be interesting to come up with an idea that is attractive to investors, that they would bet on me, right? Maybe you have the background and you're thinking about starting a company, but you don't have when I say the background, a couple of those boxes that you mentioned earlier. And you're thinking about starting a company and you're thinking about VC as the route to fund that. And you think you'd be someone that a venture capitalist would take a bet on because of your background, even though you may not have the venture capital chops. These types of founders, like, they need to know these things because they are trajectory drivers of your company ultimately, and probably your mental health and your stress.
This is the number one conversation I have with founders, which is, what kind of company are you building? Why do you want to take venture capital? Is it because it's cool and sexy to take venture capital? It's a terrible reason to take VC.
Right.
And you're just going to get in screaming matches with your venture investors as you fail again and again to hit their expectations. Don't take venture capital if you don't need it. Most startups do not take venture capital, but most startups don't get to talk about themselves in public the way that VCs and startup founders who do take VC get to. VC is amazing at marketing itself, first and foremost. And the reason being, people ask why we don't have stories about bootstrapped companies. It's because there's no checkpoints. You started a company. You're bootstrapped. You make a lot of revenue. But you generally don't tell people how much revenue you're making. What do we write about? In VC, we write about the Series A because it's a moment in time. We have a little bit of data on them and we talk about their story. Bootstraps don't have the same media market. They don't have the same information and checkpoints. They don't have the same institutional funding mechanisms that VC does. And so VC is great at talking about itself, and that's why we don't hear all the bootstrap stories. The other reason we don't hear the bootstrap stories, and bootstrappers don't like this, is that most of the time they grow slowly. there's a reason why a lot of companies who have made it to IPO have somewhere along the way taken VC, because they're trying to grow super fast. So I think building a bootstrap business isn't a fantastic thing to do. And it could be even better economically for you and some early employees. But it generally means you'll be left out of the media machine. So if that matters to you, or if you want to build $1 billion company, you should still consider VC.
Right. It's interesting. Ryan Hoover had shared, co-founder of Product Hunt, had shared a tweet recently, or a post recently. It was in his most recent newsletter about some of the changing things, I guess, things that are glorified in Silicon Valley. And of course, raises are still sort of the big media driver, but revenue has become more at the forefront than it has before, which is great. The interesting thing is how reliable is the ARR that's being glorified or celebrated.
Glorified is a good word for it.
Yeah. So it's interesting.
Look, like, this is a function of, okay, all these AI companies are growing real fast, right? They're posting revenue marks that we've seen the charts where it's like, this is how fast Slack did it, and this is how fast OpenAI did it. It's like 2 years earlier. And then the question is, how reliable is that revenue? How defensible is that revenue? And I think that we are starting to see that some of it is pretty reliable. For more than, many of those companies that are growing fast have been through annual renewal cycles already, meaning their customers stayed by and large. Not all of them, and some of it's much more worrisome. And then there's that other question that comes up along the same lines, which is, take the coding space, for instance, like Cursor and Windsurf and all the IDEs. There's all this story that's like, well, it's super easy just to sub one of those products in and out, right? There's no moat. I can just, if somebody offers me a better deal, I'm gone tomorrow. I don't really believe that. There's a lot of product work that goes into like how you feel and experience that. I don't think that's actually what's being asked. Most of the time behind that question, what people are actually asking is, am I going to use this in 3 years, or am I just going to use Anthropic? Am I going to use this in 3 years, or am I just going to use OpenAI? Like, how much are the foundational models going to continue to eat into all the application layer stuff? To some people, that sounds like the same thing that they heard 10 years ago, where it was like, what if Google builds your product? And then all the founders go, that doesn't matter. Like, good luck. Google tried to build a Facebook clone, didn't work out for them, like all that stuff.
Sure.
In this case, I might be a little bit more worried that Anthropic and OpenAI are really going to just eat this market. Maybe I'm wrong there. There's real differentiation at the application layer, but figuring out what counts as a good moat these days is very hard. It's harder than it's been in many, many years.
Yeah, that's interesting. And two thoughts on that is this is a trivial example, but switching from if you're a consultant and you build PowerPoints for a job frequently, or if you're in investment banking and you build a lot of presentations, and your company switches from Google Sheets to PowerPoint, it's a big change. Like, you lose a lot of productivity because Google Slides. Google Slides.
Yep.
Similarly, like, if to your point, if you know Cursor and then your company says, hey, we're going to switch to Windsurf, then you've got to like become this Windsurf expert, or try to get to the same level of expertise that you had with Cursor now in Windsurf. So I agree with you there 100%. I think if Anthropic does build a product that's just simply better and they can continue to fund it because they're Anthropic, then how do you compete against that? So that's the risk. And then obviously they control the models too, right?
Sure. Yep.
And who knows who they'll give access to the models into perpetuity. I mean, that's an interesting conversation. Probably it's a whole nother rabbit hole. Additionally, if you're celebrating revenue, but your margins are getting crushed at that revenue, how long can you keep up like your revenue getting crushed by compute to be able to drive that revenue?
Yeah. So this is the profitability question. And I think this is the hidden thing that a lot of people, we're talking out of both sides of our mouth, right? When we as the VC community, which is we point at founders and we say, grow as capital efficiently as possible. Like, you should try to get to profitability as soon as you possibly can. And then we point at the champions of AI, the ones who are raising the massive rounds, and they are like taking money, putting it into a giant pile and pouring gasoline on it. Like OpenAI is spending billions and billions of dollars a quarter to fund their growth. But the growth is so high that nobody cares. And this is, to me, the core of what VC really is, which is, leaving bootstrapping out of this, but for VC-backed businesses, you can talk about profitability, you can talk about capital efficiency, you can talk about all sorts of metrics and ways to make you look good. What matters is how fast you're growing. That's all that matters, really, at the end of the day. If you show me a company that is growing 1,000% a week and they're at $1 million in ARR, I'm going to fund that company regardless of how much cash they're burning.
Right.
Because the opportunity at that scale, if they can ever get their unit economics to work, is gigantic. It's consumer level scale, which is the best kind of scale you can have. And so that's what they're funding. And I think there was this rotation towards profitability and capital efficiency for a couple years when the funding was harder. But now if we're back in an AI boom, funding will get looser again. And wild deals will start happening and all the headlines will be full of crazy, crazy numbers like they are today.
Yeah, I just remembered, it feels like just yesterday that you have people like Brad Gerstner, Bill Gurley that are like, Zuck's getting fit. Zuck got
Right.
fit, and now he's spending $300 million on one engineer.
Yeah.
Oh my
right.
gosh.
Fitness
Man.
in this case is just like have the best talent teams. That's actually another, or maybe we don't want to get into that, but like the decoupling of value from product to talent. Like talent has always been valuable, but I think that talent is now being recognized, at least at the very upper echelons of like AI research, as the thing that matters. And, Zuck and Google and others are willing to pay what 2 years ago would have looked like exorbitant prices for talent, because if the opportunity of AI is $10 trillion, then who cares about $300 million? It doesn't matter.
Right.
Yeah.
Man. Crazy time, and it is a space that moves fast. That's for
Super
sure.
crazy.
So let's shift into the bootstrapped conversation. So I have some data here. We'll do the same thing on the editing process. I'll put this up. But for those who are listening and aren't watching this on YouTube or Spotify, I'm going to read the data here. So it says, so Ben Lang shared some data that obviously came from you guys at Carta, showing the growth in solo founder startups.
Yep.
This data was split by solo founder startups that had raised venture capital and those that were bootstrapped. So in 2024, 38% of startups that had not been VC funded are solo founded, and that's up 22% from 2022. So that was percentage change, not just percent minus percent. And then in 2024, 17% of VC funded startups are solo founded, which is down 6% from 2022. So what does this data tell you about the state of solo founding today?
So just to like replay that,
Yep.
all this shows is that if you are bootstrapped, you're much more likely to be a solo founder. Solo founding is becoming more and more common across all startups, but then you get to the point of funding and VCs don't like solo founders. Hands down, there is no data that proves otherwise. There are individual VCs who say part of their thesis is solo founders. I don't believe them, really. I get it. You have to say some things occasionally. This question, though, is, okay, so first question, why are solo founders more common today than before? Lots of obvious reasons. It's easier to start a company. You've got companies like Stripe and Carta, et cetera, to help you build an AI. Maybe you're a non-technical person who can now build technical things with AI. You start a company, makes a ton of sense. I'd be shocked if that wasn't the case. The real interesting question is, why do VCs still dislike solo founders? There are some people like Julian Weiser at ODF and others who are like taking this on as a new project. I love that. I think that solo founders can build amazing companies. The traditional reason why you don't like solo founders as a VC is twofold. One, it just is an obvious heightening of risk. Not just that this person might get hit by a bus, because that's always kind of true, right? It's kind of a silly reason. More that this person isn't going to be able to do everything that the business needs. So if they're a technical person, they may not be able to stretch into all the business aspect, or vice versa. And so like having a 2-founder or 3-founder team distributes responsibility and just allows for more surety on the VC side that like this isn't going to go to total zero because somebody just cracks up.
Sure.
The second reason, the reason why I think most VCs don't like solo founders as much is because they don't like thinking that like this person can attract a team. So it's about like their ability to have enough charisma, however you define charisma, to attract the right people. And that founding team is like the most important people that you could ever attract, or your co-founders. So there's a lot of reasons why that is. I think that is not gonna really go away. I mean, I believe in Julian's pitch here, but I think that most of the time VCs are gonna prefer founding teams to solo founders. Almost always, for good reasons and bad. And so it does leave a gap if you can be a really amazing, high quality solo founder. If you're a solo founder, bootstrapper, indie hacker kind of person, do you want venture capital? I mean, the exits need to be, you don't need a giant exit to have life-changing wealth as a solo founder.
Totally. Yeah.
You, a tiny team, you exit for 20 million bucks, you take 10 home, you just changed your whole life, you know? Whereas if you did that same thing with a bigger team and some VC funding, like you didn't change anything. You just became an employee at like an acqui-hire or wherever. So I think, again, it gets back to like what kind of business, what kind of founder do you want to be?
It's funny. There is a very popular, very famous founder who I think sold his first business for $25 million and I think took home 10. Yep. And it was Elon Musk. And then he I think he took a little bit of venture capital, I think from some publishers. But yeah, 25 million. I think he took home 10 and he doubled down, obviously.
There it is.
But yeah, totally. I mean, $10 million, life-changing money. And I think it's interesting, you know, what Julian's doing. And Julian, if you're listening, I would love to have you on the podcast. So come on, let's do it.
He's the man.
I think for someone like him, that thesis is like right down the fairway for him because he creates so much community with what he's building through platforms like ODF. You know, he's able to almost give founders the support and the community that they need to not feel quite like a solo founder. And right. I guess to be fair, like I haven't read the terms, but like if one of his solo founders ends up meeting someone else in the solo founder cohort and they want to, you know, work together, then
do they get kicked out of their cohort?
Do they leave? I don't
room
know.
and board no longer available to you. Yeah. How dare
Right.
you find a co-founder?
Right.
That's funny.
Right.
But they are like sort of helping each other, you know?
Totally. Yeah, he's created this community. So for someone like him, it's perfect. You know, and I know YC, I had Calvin Chen on, who's a YC-backed founder, and YC is historically obviously not really big fans of solo founders, but they even say like they don't even really recommend to co-work because if you co-work, you're surrounding yourself, you regress to the mean potentially. Yeah. And so, yeah, it's an interesting, I don't know if I agree with that, but that's the,
it was very dogmatic,
but
right. I look, hey, you can't knock YC's model. They've absolutely crushed it. So I do think it's how to build a company, how much money you need, and who your team should be. We haven't even talked a little bit about beyond the founding team, just like the phenomenon of building with fewer and fewer people is a really big trend right now across startups. And I feel I'm kind of two minds about it, honestly. I think it's great for the individual businesses in that if you can run fast with you, couple co-founders, couple engineers, run fast. You know, you can use agents to do a lot of this work. You can code a lot faster. You can build so much more quickly. It's amazing. It makes me kind of sad. Like my career, I owe a lot of my career to people taking a chance on me as employee number 8 or 9 at early stage startups. And I was at that point not technical. So where do those people, how do those people fit in to this new world is, I think, a little bit up in the air. And I just hope that there's room for, not everyone is going to want to be a founder. Some people want to be joiners to small places. And I don't think that's a bad thing. I don't look down on people who don't want to be founders. So I hope that they still have a space in startups.
Yeah. Well said. Well said. We can land the plane on something that generates a lot of conversation on the internet, which is where should you build your company? Should you build it in New York? Should you build on the West Coast in either San Francisco or LA? Yep. Should you be a little indie and build in a place like Chicago? So I have some data here, but before we read the data, obviously, you're very familiar with the data because, again, you produced it. I'm curious, where would you build a company today if you were building one?
Woo! Spicy subject. Everyone has an opinion. Turns out that opinion is very dictated by where you live, surprisingly. Sure. If I'm a founder and I'm trying to build a venture-backed business, I am packing up tomorrow and moving to San Francisco.
Okay.
Hands down. If I live in New York, maybe I don't. If I live anywhere else in the States and I want to raise VC funding, I'm at the very least visiting San Francisco a lot. The level of capital available here is radically different than everywhere else. There are no mature venture ecosystems beyond SF and kind of New York. And I say kind of. New York has an amazing venture ecosystem, but it doesn't touch SF, really. So that's the base case. Underneath that, I think you can still build, and our data I think shows this, you can get started basically anywhere, right? Maybe not like Chattanooga if you want to raise VC, but
Break VC. I think what are they called? Brickyard VC. They're somewhere in Tennessee.
All right. Well,
but
no shots at Brickyard, no shots at Tennessee. But it's like, yeah, not a venture hub.
Right.
But pre-seed, like you can raise pre-seed rounds. You can even raise seed rounds occasionally in lots of different cities. Seattle, LA, Austin, New York, Boston, et cetera, on down the line. But if you want to get into traditional venture capital, full scale, I'm going to raise A and B and C and do the thing, you are inevitably going to be talking to Bay Area investors. So why not just know them early on is really the biggest thing there. Caveat to that. That doesn't apply to specific industries as much. So if I'm building in biotech, both San Diego and Boston are pretty amazing markets to build biotech companies in. If I'm building, in crypto, I might not need to be in San Francisco quite as much. So there is some like nuance here by sector. But in general, I think that if your goal is to raise funding, there are many, many more investors for you to meet in SF than anywhere else. And density matters in that sense.
Sure. Yeah. Shots on goal for the founder, right?
100%. Yep.
Pitch meetings, et cetera. Yeah. To share some of the data here for folks who might be listening. So, some of the data you shared a while back. So, I think it was Q2 2024 to Q1 2025. So, the Bay Area was number one at 39% of total capital raised for that time period. New York at number two had 12% of the total capital raised, so 3 times less than the Bay Area had. LA was number 3 at 8%, so still California concentration. And then some interesting numbers that I found interesting were Miami at number 10 with 1% of the total capital raised.
Mm-hmm.
And obviously Miami, that was in vogue for a quick moment. And then Chicago, I'm biased to Chicago because I'm in Chicago, was not even on the list of total capital raised. So doesn't mean there's some other data here. It's strong in pre-seed and seed on safes.
Yep.
So an interesting niche, but as far as total capital raised.
So this is data that always gets me in trouble with Chicago and otherwise. And I think what it's trying to point out is anytime you look at VC now is way too broad a word to have new participants. So if you count an investment into SpaceX and an investment into a pre-seed company as venture capital, both of them, then the list of cities that have the best venture capital ecosystems will never change because the late stage rounds are gigantic and you can have literally 1,000 early stage rounds and not even come close to how much money was put into XAI or, Anduril or something. So if you just do it on total capital raised across all quote unquote VC, the lists never change. They're the same list, which is why it's useful to split it out and say pre-seed list, seed list, series A, etc. What you notice there is there's a capital concentration in the later stages on the coasts, and there's a little bit more of a better distribution for capital at the earliest stages. And then you see things like Miami, which everyone likes to shit on Miami. I think Miami's an amazing story. Miami had no VC ecosystem before 10 years ago, and now they're in the top 10 for pre-seed and sometimes safe work. Like, that's really great. And again, if they're building an ecosystem, how is that going to start? It's going to start with very young companies who raise very little rounds. So pre-seed and seed. Like if they were ever to show progress, it would be at those categories, and they are showing progress. I don't think Miami is going to overtake Silicon Valley anytime soon.
Sure.
But I think they've done really cool work. Austin, the same thing. Austin is like a very viable venture ecosystem in a way that it wasn't 10 years ago. Boston is the best example of a place where you took one industry and you made it a whole ecosystem. So it's no longer just for biotech companies, SaaS, health tech, all sorts of adjacencies there too. So I think it's generally a picture of venture as being deepening in a lot of cities, but as it's doing so, it's still getting further and further ahead for Silicon Valley. Like it's deepening everywhere, and whatever had the deepest roots to begin with are even deeper now. There's been no closing of the gap, really.
Interesting. Yeah, one of the numbers that really jumped out to me was Austin at number 2 for hardware.
Yeah.
Total capital raised at 19%. What drove that? Do you recall?
A lot of hardware companies coming up in Texas. You know, we've got some like hardware companies coming up in outside of LA as well, in the El Segundo area, et cetera. Right. So 2 new hardware places. I think some of that, I don't think the Elon effect can be overlooked there. Those are 2 places that he has had a very big impact on, especially in Texas. And then Austin's a cool mix of stuff. They really don't crush any one thing. Like that hardware number will go up and down a little bit quarter by quarter. But they have a lot of, they're pretty good at a lot of things. There's actually a big debate amongst people who want to seed venture capital in places, and they say, what's better for an ecosystem? To have one big spike or to have like a range of industries that you do? I actually think it's probably better to have one big spike and then expand as opposed to trying to build everything at once. But Austin is the counterpoint to that model because they basically just built a ton of startups that are all doing all different kinds of stuff.
Interesting. Yeah, and then to touch on your other point about Miami and Chicago, so the numbers here were that percent of total capital raised by stage for pre-seed, Chicago and Miami were number 7 and 8 respectively. So Chicago got on the list, and Miami moved up the list at pre-seed, big W. And then for seed on safes, Chicago was number 6 and Miami was number 7. So interesting, just to further validate your point, which is, looking at it by stage tells a different story than obviously just percent of total capital raised.
And this is one of the things that whenever I put these rankings out, people ask for is like, well, what about per capita? Like startups fundraising by number of people. And it's like, that doesn't really matter. Like no one thinks about that. No one thinks about ecosystems by like, we're doing great on a per person metric.
Right.
But if you were to do that, so 1, I think that's a silly request in many ways. 2, if you were to do it, you would need to figure out like number of people involved in startups. It's not total population, like number of people involved in startups. And that's where I think you can explain Chicago specifically and Dallas in particular in better terms, which is they're really big places population-wise, but there's not that many people involved in startups there.
Totally.
So like where they rank kind of makes sense. Whereas obviously Dallas-Fort Worth is a much bigger place population-wise than San Francisco, but San Francisco probably has more people involved in tech. And that's the thing that matters. So, and whenever I do this list and you actually do it per capita, the place that comes out best is Boulder because like there's nothing else there but like climate tech and cool tech stuff, but it's also tiny. But I would be kind of weirded out by any list that says Boulder is the number 1 venture capital ecosystem in the U.S. That's not what the word means.
That's super rich. And just my own lived experience, I'm from Dallas-Fort Worth area, and it's just like I have not personally lived in San Francisco. I would say I interact with a lot of people that live in San Francisco these days, and people don't think about startups as like a viable career option really in the DFW area, relative to a place like San Francisco. And you see,
and not only do they not think about it in terms of a career, which is like the fodder you need, right? You need founders. Totally. But even on the funder side, I've had this debate with Jason.
Calcanis?
Yeah, well, no, not Jason. The other Jason. Well, there's a lot of Jasons. Jason Lemkin at SaaStr is an amazing dude. I am thinking of the other Jason. I can't remember his name. He works at Austin, like What's Next Austin. So we talk about venture ecosystems all the time. And one of the things that I think is interesting about the Bay is this question of like, what do rich people do with their money? So what, like individual rich people, in Dallas, they might invest into real estate or other things. In the Bay, they're angels. Almost all of them are angels, even if they don't really
Yeah.
want to be angels. I know a lot of pretty wealthy people in San Francisco who kind of don't want to do angel investing, but they feel like they have to like be in the scene. Um,
Yeah.
and so it's just funny. It's just like, what do wealthy people do with their cash? And in Silicon Valley, they invested into tech startups. And I was just like,
Wow.
that's how you have an angel community that's this vibrant, is because a lot of them made their money in tech and they're just going to put it back into what they know.
That is super interesting. Yeah.
Yeah,
I mean, yeah, people in Texas go buy like a ranch or they'll go
totally.
like,
Might be a better
they'll get a
investment.
lake house.
Yeah,
Right.
no shots at that. I get it.
Man, well, Peter, for founders who have, let's say, ancillary or adjacent knowledge of venture capital, this is going to be an absolute crash course for them. So thank you so much. Is there anything that you would want to leave that group with that maybe we haven't talked about yet?
Yeah. I think the number one thing to understand about VC, if you are not sort of in the water here in SF or other places about it, is you need to, before you ever think about fundraising from venture investors, drop the idea of fairness. This is extraordinarily and by structure unfair. So do not expect fairness from any investor or any process out of venture capital. They are not in the business of giving you a quote unquote fair shot. And so that seems aggressive. What do I mean by that? What I mean is it is an incredibly risky thing to invest money into startups because most of those startups, let's talk 9 out of 10 at least, are going to fail. So in a world in which you're going to invest 10 times and lose money on 9 of them, you really look for every single angle to de-risk the investment. And the easiest angles for de-risking are people who've done it before. So you think that like all this focus on networks of where somebody worked or what they did before or where they went to school or like their knowledge of VCs, it all feels very chummy and like old boy networks and like it's bad. And it is in some ways. But it also is what the ecosystem drives towards because of the risk involved. So, and a great example, Brett Taylor at Sierra AI raised like $100 million in a weekend for his new, it wasn't even a company, it was like on a napkin, right?
Huh.
Why is that? Who is this guy? How could he do that? Yeah, he invented Google Maps. So if you invent Google Maps, you get to raise $100 million, no problem here in the Bay. If you are not Brett Taylor and you did not invent Google Maps, you're probably not going to raise $100 million on nothing, right? So it's like, that is the perfect idea of like, that's what legibility means. Brett Taylor is the most legible person that you don't even have to explore it. There are people clamoring to give him money. If that's not you, you should not expect to be treated that way. You'll have to prove it in a lot of different ways. Doesn't mean you shouldn't take VC. It just means you shouldn't expect, like if I gave 100 people the same product and the same traction and went out to VCs, every one of them would come back with a different valuation for the business. And that is definitely unfair. And also, I kind of get why that happens.
What's the best way to follow on that? What's the best way for a founder to prove it?
Revenue is the easiest way to prove it. But failing that, I think it's useful for founders who are thinking about trying to join like SF or New York based VC networks to like just study the game for a while. And it is a game. And games can be good and bad, but study the game for a bit. And what I mean by that is you shouldn't go and blast 1,000 investors with a cold email when you don't know how to write cold email for San Francisco investors. Right? You shouldn't go and try to like talk somebody's ear off at an event here in the city when you have no connection to them or their fund, or you don't even know what kind of thesis they invest in. Like do the work up front if you want to be a founder that is legible to these people. But first and foremost, and probably way more important than any founder work you're going to do, is like just build a great business. But it's just this like general admonition that if you want to be in this game, it's useful for you to go and study the way the game works. There's a lot of places to study that. YC puts out a ton of content to help you study that. A lot of VC funds will put out content to help you study that. If I'm a founder, the first people I'm talking to are not VCs, it is other founders. Like go learn from other founders first and foremost, get their real insights. And then if you need to, go and talk to investors. The last thing that I'll say, and again, this is sometimes surprising to people who are not in the networks. There is no such thing as meeting a VC casually. If you have coffee with an investor, that is a pitch meeting. Even if you're not pitching. So they're gonna have a judgment of you based on how that meeting goes. So don't assume that some meetings are like off the record or on the record, whether you're talking to investors. Like, everything is forming an impression of you in the business. So don't just randomly have coffees with investors that you don't feel ready for. Make sure you're prepped. Always just mind your P's and Q's. Like, know that what you want and like go and search it out in a more systematic way. Because we're all human and we just make judgments about people that we meet.
Right. Yeah, that's great advice. And I'll throw one more thing in there of a publication you should follow. It's Peter Walker on Twitter and Peter Walker on LinkedIn. He puts out great content, as you've heard today, or as you've seen today if you're watching the feed. Peter, this was awesome conversation. Really appreciate your time. And I encourage everyone who may be considering starting a company or is starting a company to make sure that they look at Carta, consider Carta for their cap table, because I'm sure Peter would thank you.
I appreciate it, man. Thanks so much.
Awesome. Thanks, Peter. Have a great one.
Cheers, Chase.